Hi there, and welcome to the second quarter 2023 investment performance update. I'm Matt Fettig, Chief Investment Officer at San Diego Foundation. The second quarter was one in which equity markets continued their strong upward move, really a function of slower inflation resulting in less increases from the Federal Reserve to short-term interest rates. In addition, we had the phenomenon around AI, which really became front and center, AI being artificial intelligence, and that led the market to appreciate pretty dramatically during the course of the first two quarters of this year. Really a marked difference from what we saw in 2022, as both equity markets and fixed income markets suffered double-digit rates of decline. So far this year, we've seen public equity markets appreciate significantly, but the one component that's really fallen behind is our investments in the private equity world, particularly in our endowment portfolio, and I'll talk more about that when we get to that section. So let's jump right into it. The endowment portfolio as of June 2023. For the quarter ending June 30th, the endowment portfolio was up 3%, outpacing its policy index or its benchmark at 2.8%. And for the calendar year-to-date period, the first two quarters of this calendar year, up 6.5%, outpacing its policy index of 6.1%. Of course, for longer periods, the 1 year, the 3 year, the 5 year, the 7 year, the 10 year, very strong performance, all ahead of the policy index. If you reflect back on the performance of 2022, this portfolio was down about 7%. Most of our peers that held positions primarily of stocks and bonds were down significantly more. We had other asset classes that provided strong diversification, such as hedge funds, private equity, private credit, and that worked very well for us last year. Unfortunately, those areas that helped the portfolio in 2022 are now holding the portfolio back to date in 2023. Since the start of this calendar year, private equity returns, private credit returns, real estate returns have been flat to slightly down. There's been a lag effect as those valuations are still falling due to the equity market and bond market declines of 2022, whereas the public markets, public bonds, public equities, have increased dramatically so far this year. We've still seen good relative returns out of the majority of the asset classes in this portfolio. The reality is many of them, if not all of them, have not been able to keep up with the very robust returns we've seen out of the public equity market. Now let's move to the long-term portfolio. Long-term portfolio has about 50% exposure to stocks, 20% exposure to bonds, and 30% other. It's certainly been able to capture a lot of the upside that we've witnessed within the stock market over the last 6 months, up 3.7% for the second quarter and up 7.9% for the first half of the calendar year. You can see longer term returns are all there, outpacing the policy index. So here, again, many of the diversifiers that we hold in this portfolio, primarily hedge funds and real assets, tended to perform very well in 2022 and help protect capital during that time period. Unfortunately, again, while performance has been relatively strong for those asset classes in 2023, the results have not been nearly as strong as the public equity book, which has accelerated greatly as it snapped back here so far in 2023. The medium-term portfolio. 22 was characterized by an environment of high inflation, which meant rapidly rising short-term interest rates, which really sunk the global equity market. This portfolio has about 70% exposure to bonds, and in that environment, as short-term interest rates are increasing, bond prices decrease. So while this is really meant to be a moderate volatility portfolio, it experienced fairly high volatility last year. So far this year, in 2023, we've had quite a bit of comeback. Remember, this portfolio only holds 25% in equities. Therefore, it should not have that sensitivity to the strong equity market that we've seen so far calendar year to date. So this portfolio over the last 3 months up 1.2%, and over the calendar year to date period up 5.1%, outpacing its policy index and also doing so over all of the longer term time periods. So let's move to the intermediate term portfolio. Again, this portfolio was only started a couple years ago. It does not have a very long-term track record, but it is composed 100% of bonds. It's about 60% intermediate term bonds and 40% short-term bonds. So once again, this portfolio had a difficult coming out of the gate period in 2022, as we did see those interest rates rise. Over the course of 2023, slightly better returns. You can see marginally down for the June 30th ending quarter, but up 2.6% for the calendar year-to-date period and well ahead of its policy index over the 1-year period. And last, the short-term portfolio, 100% money market funds. Therefore, this portfolio is going to have a high amount of correlation to short-term interest rates. As you can see here, the quarters on the left of the chart or graph indicate that the portfolio had a 0% rate of return for several quarters. That was when interest rates were at zero following the COVID period. And as the Fed began to raise interest rates over the course of the last year, you see yield coming back into this portfolio as of June 30th, quarter ending, 1.2% yield per quarter. So really leading to a return on cash for the first time we've witnessed in many, many years. So let's shift gears a bit here and talk about our sustainable portfolios. The sustainable endowment and the sustainable non-endowment portfolios were started at the beginning of 2020. They now have a 3-year track record. To date, they are invested exactly the same. If there is any slight difference in the allocation or the performance results, it's purely due to cash flows in and out of each of the portfolios. So with that, I'm going to talk about them at the same time. We were off to a very strong start with these portfolios back in 2020 and again in the calendar year 2021. Unfortunately, we faced an environment in 2022 where the sustainable portfolios really underperformed. A lot of that was due to the fact that the 75% in stocks completely divest from fossil fuels. That is the goal of this portfolio, and unfortunately it did hurt us last year. Energy stocks were the best performer in the S&P 500 throughout the course of 22. This year, to date, you can see the portfolio is lagging again, up 5.4% for the calendar year-to-date period, behind its policy index. To date this year, we've witnessed the one manager that manages the global equity component really underperforming relative to its benchmark. We've recently placed the manager on watch, and we are looking for other alternatives to perhaps complement that manager or perhaps replace the manager should we feel the need to do so. I hope this session was informative, and as always, if you have further questions, feel free to reach out to me through your donor manager. Thank you for joining today, and see you next time.